Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in company filings. Get ready for a real page turner. Because today we're diving into Medicus Pharma's latest report, and let's just say there were some crucial decisions made and some numbers that tell a very interesting tale. This filing is a current report that Medicus Pharma, also known as MDCX, is required to submit to the Securities and Exchange Commission when certain important or material events happen. Think of it as a company's way of saying, hey everyone, something important just happened and you need to know about it. It's filed because on that earliest event date, which was July 22nd, 2025, the company held its annual and special meeting of shareholders. This means the people who own a piece of Medicus Pharma, the shareholders, got together to vote on some really important company matters. Medicus Pharma is listed on the Nasdaq Capital Market under the ticker MDCX. They also have warrants trading under MDCXW, which are like options that give holders the right to buy company shares at a specific price. In this case, that price is 4.64 and 6 price is $4.64 per share. The company itself is incorporated in Ontario, Canada, but the principal executive officers are in Conshohocken, Pennsylvania. They've also elected for the emerging growth company status, which essentially gives them some leeway in complying with new financial reporting rules. It's like a temporary pass to ease into stricter regulations. Principal executive officers are in Conshohocken, Pennsylvania. They've also elected for the emerging growth company status, which essentially gives them some leeway in complying with new financial reporting rules. It's like a temporary pass to ease into stricter regulations. So, what did the shareholders actually vote on? Well, the first order of business, Proposal 1, was to approve KPMG LL as independent auditors for 2025. This is pretty standard procedure. Auditors are like the forensic scientists of the financial world, making sure the company's books are in order and that everything looks clean. The voters overwhelmingly agreed, with a massive 13,261 52 shares voting in favour and only 55,738 holding their vote. This shows a strong confidence in the auditors, overwhelmingly agreed with a massive 13,251, reading sure the company's books are in order and that everything looks clean. The voters overwhelmingly agreed with a massive 13,028 withholding their vote. This shows a strong confidence in the auditors. Next up was Proposal 2, which was all about electing the company's directors. These are the people in charge of guiding the company's strategy. All 8 directors nominated by the board were up for election for a 1-year term, and again, the shareholders gave them a strong endorsement. For example, William L. Ashton received 10,015.94 votes, with only 17,036 withheld votes. This pattern held true for all the nominated directors. It's a clear signal that shareholders are happy with the current leadership team and trust them to steer the ship. Now, things get a little more interesting with Proposal 3. This one involved changing the company's bylaws to adjust what's called the quorum requirement. A quorum is the minimum number of shareholders needed to be present, either in person or by proxy, for a shareholder meeting to be official. Medicus Pharma needed to change its bylaws because they were moving away from being a foreign private issuer and had to align with Nasdaq rules. Specifically, they were changing the quorum requirement from 10% to 33% of the outstanding shares. This means a larger group of shareholders, a third of them, now need to participate for decisions to be officially made. The vote here was also heavily in favour, with 10,027,547 shares voting for this change. This move is all about ensuring proper corporate governance and meeting exchange rules, which is vital for maintaining their listing on Nasdaq. Proposal 4 is where we see some significant strategic action. This proposal greenlit the company's plan to issue, sell and deliver common shares under a standby equity purchase agreement. With YA2PN into the T detail here is that this issuance could represent 20% or more of the company's outstanding shares, and importantly, it could be at prices below Nasdaq's minimum price rules. This is a common financing tool, especially for companies that need capital and might not have immediate access to traditional loans or might want to raise money without a massive immediate dilution. The shareholders approved this with 10,063 of 9047 voting for it. This tells us the shareholders are comfortable with the company raising capital through this specific agreement, even with those potentially lower prices. It's a vote of confidence in management's ability to use this capital effectively. Finally, Proposal 5 concerns a change in how the chairman of the board can be removed. Currently, removing the chairman required a 2/3 majority of the votes cast by shareholders at a meeting. However, this proposal sought to amend the company's articles to increase the threshold for removing the chairman. Specifically, it would now require a vote of at least 75% of the board itself to remove the chairman. This is a pretty significant change. It essentially makes the chairman's position more secure, as it shifts the power from a shareholder vote to an internal board decision, while the shareholders are pro within the board regarding the chairman's position. More secure as it shifts the power from a shareholder vote to an internal board decision, while the shareholders are power within the board regarding the chairman's position. Following the meeting on July 23rd, Medicus Pharma issued a press release to announce the results of these shareholder votes. This is also standard practice to keep the public informed about significant corporate actions. The press release is attached as Exhibit 99.1 to this report. The filing also lists the exhibits included, with Exhibit 99.1 being that press release summarizing the meeting outcomes, and Exhibit 104, which is the cover page interactive data file, a bit of behind the scenes tech stuff for digital filing. Now let's put on our analyst hats and look at what all this means. Medicus Pharma's shareholders have clearly shown a strong trust in the current board and their leadership. The approval of KPMG, the re-election of all directors, and the backing of the equity purchase agreement all point towards a management team that has the confidence of its owners. The most notable change is the shift in how the chairman of the board can be removed. By increasing the threshold to 75% of the board's vote, the chairman's position becomes much more insulated from shareholder overtures. This could be seen as a move to ensure stability at the top, but it also means that removing a chairman, even if circumstances warrant it from a shareholder perspective, becomes a much higher hurdle, essentially requiring overwhelming support from within the board itself. The Nasdaq quorum change is a procedural update, ensuring the company operates within exchange rules as it evolves. The approved equity purchase agreement is a financial lifeline, a way for Medicus Pharma to secure funds for its operations or growth initiatives. It's a common strategy for companies needing capital, though it's always important to track how that capital is used. And alright, that's our breakdown of Medicus Pharma's recent filing. What's your take on these board changes and the equity financing? Let us know your thoughts in the comments below. If you found this deep dive helpful, give us a thumbs up and subscribe for more corporate decoding, and don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, see you next time.